Hello, welcome back. This is Eduardo coming back to you with another episode or our first lesson on iron condors and exposure to iron condors. So on this YouTube video that I'm going to make here for you guys today, I'm just kind of going to show you the power of iron condors and maybe strangles or straddles and how to set them up. So I'm going to use this ETF that we have here. This is XBI as an example. What you see here on the screen is the price action for XBI within the last year or so. And after this, I'm going to show you how to create an iron condor. So let's go ahead here to the Analyze tab. I'm going to show you guys what a P&L graph looks like. And basically what a P&L graph is, it shows you, it helps you visualize how much profit you will make on a trade and how much you could lose on a trade as well. So let's go ahead to the Analyze tab right here. And as you can see, I have XBI pulled up here, but there's nothing populated. I went ahead and made a strangle and iron condor around the current price for XBI. And the reason I did that is kind of to shorten it and show you the type of percentages you can make. I'm sorry, the amount of money you can make for a certain trade and the probability of success for that trade. So we're going to go ahead here and we're going to pull up the iron condor that I made for this trade. So boom, there you have it. This is an iron condor. So what you can see from this graph here is this is the zero line. This means $0. And anything below it, it means you're losing money. Anything above it, it means you're making money. So above here, you have 500, 500, negative 500. And you can see on this graph that the blue, there's blue and there's purple. Blue shows you at the end of the iron condor after a certain time when it expires, the max amount of money you can make. And the purple shows you the current amount that you are making on this. So after time passes by, this purple actually forms into the blue. So this comes down, this comes up, and that's called theta decay. And that's how we make money when we make iron condors and we sell premium, which is the term that we use to explain how much money we make. It's called selling premium. So we sell premium, and on a daily basis, you are essentially making money every time that time has passed by for this option, because we are selling an option. So we're selling it to somebody. Somebody is losing money every day on this option, but we're making that money. As long as it stays within this range, we are profitable for the most part. So here at the top, you can see I have already set up kind of like the break-even points. So at this point and this point, within this, we are profitable. Below this, we are not profitable. And you can see here, there's a percentage, 63.98%. That right there is very important. That tells us at the time of expiration for this iron condor, which is May 17th, that's our probability of winning this trade. And our profit, let's go ahead and change the contracts. Let's say we just do one contract. I'm sorry, not one contract, one trade, one iron condor. Okay, so if it stays within this price range right here, we are making $94. You can see the prices down here, $94 if it stays within here. However, if it falls out of it, we are losing $206. This is your probability of success right here, 63.98%. All right, so there's ways where you can make this a higher probability of success. This is kind of like a sweet spot right here. We have it set around 1 standard deviation, which is essentially what it means is it's normally about, how would you say it? 1 standard deviation is 1/20 delta or so. So that I'm just complicating it for you guys right now, but essentially means it goes far out the money, enough for you to make a profit. 2 standard deviations, it's even further. This break-even point would be out here, so your probability of winning in this trade would be higher. However, the amount of money you'll be making would be lower, right? So 1 standard deviation is kind of like that sweet spot that people have, they like to trade within. So that is what a iron condor looks like. Now, the kind of like a similar trade to an iron condor is called a strangle, and I went ahead and made a strangle as well. This is a strangle. So the difference between an iron condor and a strangle is that a strangle does the same thing. It does capture a certain range, but the downside of a strangle is that there's infinite loss. So let's say that the price of XBI continues to rise and it goes with beyond our price break-even point, which is right here, and it keeps going. You can keep losing money infinitely, essentially, if it keeps going, right? And if it goes below this point, it can also lose money. But that is the risk of trading what's called a naked option, right? So naked options. But the upside of it is that it increases your probability of success. So you can see here that the break evens moved. So for the Iron Condor, where the lines are right now, that's exactly where the break even is. But for the Strangle, you can see that they moved out. So if we go up here and we set the slices to the break even point that is now out there even more, you can see that our probability of success is now higher. So we have a 71% chance of success, which is higher. Also, the amount of premium that we collect is higher, so we make more money off of this. So if we're selling, let's go back to one contract or one strangle. If it stays within the money, if it stays within this range, we're making $168. And then if it comes out, like I said, you have infinite loss on both sides, but it will not normally go way out of this zone. It's not something that's very common. It will probably come out here, but it'll never just drop. Like there's no way that the stock market would just go straight to zero. That's almost nearly impossible. So what you're paying, what the difference is between those two is you're trading, you know, your risk, and you're creating a bigger profit because you're basically, you have a little bit of more risk, but your probability of profit is increased. So that's the take and the give from that. So here is an Iron Condor. And once again, it's a different probability of success, but this is the power of it. So essentially, this is what an Iron Condor is, and the odds are in your favor. So you will end up winning 64 out of 100 times, and the probability of you winning is actually a lot higher than that if you include different measures. So what a lot of traders like to do is they take profit at 50%. So the max profit you can make on this is $94. A lot of traders like to take 50% of that. So they'll take profit at around $47, $45, and then they'll call it quits. And what that does is that it reduces the risk. That's less time they have to be in the trade. So the amount of money that they make is less, but it drastically increases their probability of profit. So the actual probability of profit is probably around over 70, 75, a little bit higher. I couldn't tell you the exact estimate, but it's definitely higher than 64%. And that's the beauty of it. And the way people use Iron Condors is that over time, it's a winning strategy. It's not something that you put all your money into one bucket and you do it at one time, because let's say you put all your portfolio into this trade, you come out here, you lose it all, right? You lose it all here. But if you do several trades, let's say you make 100 trades and your probability of success is about 70, 75%, then over time, you're going to win, right? And that's the gist of an Iron Condor. And that's how people make money. For example, you can see here it's been trading sideways for a while. Then we had a huge drop, and then it came back up. But you know, these type of events are not what you're looking for when you're doing Iron Condor. What you're looking for is sideways action, just like this. This is perfect right here. This is good right here as well. Even though it's been in a large uptrend, it started to stabilize a little bit here, and you can see it's trying to break out at this point here. So that's pretty much what I want to touch on here in this video. XBI being used as an example, just kind of expose people to Iron Condors. I'm by no means an expert, but I want to use this as a way to show people that there's other ways to trade options. The following videos I make will probably go more into detail about what this is. This video probably doesn't show enough, or doesn't it mentions several things that you're probably not familiar with, but we will try to go into more detail in the future as to what all of this means. So I hope you guys enjoy the video.